Hello, welcome everybody to another episode of Arthur's Roundtable. Thanks for everybody paying attention to the podcast. Super appreciate it. And also the Family Office Insights community who shared it quite freely. Really, really grateful for that as well. Brett and I have known each other maybe 15 years, something like that. Some ridiculous amount of time.
Time flies, yeah.
So we're super happy to have him today. And we're going to start as usual with his journey, and then we'll get into it from there. So Brett, thanks for doing this. Really appreciate it.
Yeah, my pleasure, Arthur. My journey is not as a crow flies, as one would say, but there are some threads as we reflect back on it. I was born in Edmonton, and then our family moved to somewhere north of Edmonton, as those of you that are in the New York, Greenwich region right now might be feeling some of the colder temperatures. It's kind of refreshing to me, as long as it's not too windy or raining and cold. That I don't like, but I actually like the crisp weather. Parents were school teachers. Mom unfortunately passed of cancer when I was young, and so the path as a teacher is to go off and teach somewhere that's less desirable and build your resume, and then move to a more desirable place to live. Unfortunately, that became a place that we stopped. I was fortunate to have parents in the school system, and very thankful for the community growing up and being involved in the school. Ended up speed skating on the Canadian national team. Post-college, I went to the oil drilling rigs to get some further cold weather for a year to pay for college. Post-high school in areas they call the oil sands and whatnot in northern Alberta and northern Saskatchewan. And I thought that was a good learning lesson, because it teaches you
What you don't want to do, right?
Exactly, right. That sometimes you figure out what you want to do by what you don't want to do. Well said. Yeah. But with all seriousness, it was a great opportunity to make money and work hard in order to pay for college. I then transferred up to McGill University, finished my undergraduate degree, and wanted to work in Wall Street. And at the time, McGill had one of the strongest launch pads into Wall Street, and was fortunate enough to get a job at Solomon Smith Barney back at the time as a division of Citigroup, which I thought was pretty fun as a kid from a small town of under 10,000 people.
To in New York, right?
Yep. Yeah, in New York. And at the time, Citigroup was the largest financial services firm in the world. And that was pretty fun. And it was a phenomenal learning experience. I was surrounded by a bunch of really smart people doing a lot of different things, a lot of deals, a lot of data, a lot of information, and pretty creative, which I found quite interesting. And I caught the bug of really marrying some of my entrepreneurial things with finance to launch a fund, which I did in 2004 with some friends and colleagues. We launched our first lower middle market private lending and private equity investment fund. At the time, working with different states in the US to help invest in local smaller businesses, which were part of economic development programs, investing in women-owned, minority-owned, and underserved areas within various states in the US. And that was a great learning experience, where you really learned the importance of being local, to engage with business owners, build trust. That was a lot of fun. Ultimately, I then built that into a business where I restructured, rebranded, and launched a new trademarkable firm called Starmount Capital in 2010. So we recently celebrated our 15-year anniversary, and I think today we have the largest, if not at least one of the largest teams that is independent and purely dedicated in a specialized way to the U.S. lower middle market, with roughly 130 full-time people and 40 operating partners. So that's and just under $5 billion of assets under management is our business today.
Nice, nicely done. Right, I've seen the growth along the way. So good for you.
Brick by brick.
Brick by brick. And also, I think it's important to note that, or at least explain what you mean by lower mid-market. I know what that is, but let's share what the business.
Yeah, that's one of the bad things about the finance industry, is fraught with jargon. Yeah. The way we think of it is companies that generally, and most broadly, this is probably a little bit broader than it's deserving, but 5 million of EBITDA to 50 million of EBITDA is where we focus. We are not specialists in the startup venture capital world. I think that's a different environment. You are underwriting different things and taking more of a a bet on different things and a different risk reward. So that's not what we do. We also don't want to compete in the larger market where very large asset managers are highly active and very fluid, and the market's more competitive. So we don't want the venture, more startup risk, and we don't want the more highly competitive market risks. And so that kind of squeezes us into that 5 to 50 million of EBITDA world, which we execute against in direct lending strategies, private equity strategies, as well as secondary strategies to really have a lot of data, insights, and capabilities within that market.
Is that deal flow still robust for you? Is there plenty to look at?
It is, and in fact, Arthur, this is now my 23rd year investing nearly 100% of my personal capital in that market. And the reason I continue to do that is the market dynamics today are arguably better than they've ever been. One, and I'm a guy that just likes thematic aspects. I don't mind working hard, and that's perhaps the thread between oil rigs, speed skating, and Star Mountain is labor. We're not afraid to work hard, but we're not people that think we can outsmart the market or time the market or be smarter than everybody else. We just think we can have, and we have a very specialized business that gives us a lot of competitive advantages. And we're willing to do slightly smaller deals with really a focus on returns and on alpha and low correlated returns. So the market today is more robust than ever. One, because of aging demographics. You have more private business owners in America today than ever that are in their 60s and 70s and saying, okay, I need to do something with my business. And we really sit down with them and understand their business and be a solutions-based partner. Maybe you have kids you want to transition it to, maybe you don't. Maybe you have partners who want to transition, maybe you don't. Every situation is a little bit different, and it's that labor involved to sit down, understand the business, come up with investment structures, pair that with specialized resources that really resonates with some of the best businesses in America. And that aging demographic just creates a demand for capital. The second thing that we like is that if you can grow a business from the lower middle market, let's just say you grow a company from 10 million of EBITDA to 30 million of EBITDA. On average, you can probably increase the valuation multiple by maybe 50%. So that valuation arbitrage, taking a company from a less efficient market into a more efficient market, allows you to capture a premium return on the business and systematically capture that valuation arbitrage, which is another thing that, again, business owners want to do. We want to help them do it, obviously, and we want to do that, with our capital and our investors' capital, which also for taxable investors ends up creating a lot of long-term capital gains and tax advantages, which in the category of luck last year, the QSBS program also updated. And so now there's a further tax advantage potential for many people. But that aspect drives more deal flow than ever, right? So if you think about that, you've got aging people, and you say, well, if I'm somebody sitting there with a $15 million EBITDA business and I can buy two of my competitors that each do 5 million of EBITDA, now I'm worth more and I can buy their EBITDA cheap. Oh, and then there's a big tax advantage aspect to it. So it's like that just drives capital demand, and at that end of the market, your big branded asset managers, I'll call them, aren't generally interested. Your big investment banks, the deal size are too small for them to get the fees, so the market remains inefficient with fewer competitors, at least fewer big scaled competitors. And so I think in my 23 years, this is probably the most robust we've ever had it.
So the deal flow's there. And then is it fair to say that the model is still, as I understood it when we talked a few years ago, is exactly what you said? You're taking a smaller company with a lower multiple just because of its size, aggregating it by merging other similar companies into it. And then it's more interesting to that acquirer that you're not competing against, but you might want to sell that aggregated entity to them.
That's right. Yeah, and if you look at the larger middle and large market private equity firms, many of them have a lot of capital and a lot of capital they want to deploy. If you look at capital formation, There's been a huge increase in capital formation going to, I'll call it the Blackstones of the world and KKRs and so forth, that have big fundraising teams and large funds. And those managers in general that have been very successful, great firms, continue to grow, and they have capital they need to put to work. So they generally aren't going to want to mess around with a whole bunch of smaller little deals. That's too time consuming and labor intensive, and you need a specialized business to do it. It's almost like, I don't know what a simple analogy is, but if you think about going fishing, right? There's a different fishing rod. You need to go fly fishing than deep sea fishing or something, but even though you're still fishing, it's a different way to find these companies, a different way to analyze them, and a different way to actively work with them in the lower middle market than it is the larger market. But if you can build those companies up and professionalize that into the larger market, now you've got a very large buyer universe and a lot of low-cost debt capital and financing capital, which I'm sure you've all read about the influx of private credit in the large end of the market. Well, that's very positive for valuations, right? When people can finance things easily and cheap, that's good.
That's good. So that's financing things easily cheap on the exit side. And just because there's not a lot of people playing in the lower middle market, you also can command higher, uh, uh, I'm not going to say fee, but you can charge higher interest rate because nobody else is really interested in doing the heavy lifting that you're interested in doing. Not to
That's right.
mention the value that you're creating uh, for somebody that's got a $10 million business and they're going to aggregate it to 30, right?
That's right. It's a bit of a step chart. So if you one of the things I like about our business, it's what I think of as a Warren Buffett style of investing, meaning a value-based investment where, on the debt side of our business, it's low leverage, it's strong covenants, but it's also a higher interest rate because the market's less efficient and there's a lot of business owners looking for capital and their use of proceeds is high. So if you're going to acquire EBITDA cheap from a competitor, is it worth it to pay us an extra 1 or 2% interest, especially if, to your last point, we can actually help you build a better business that's worthwhile? And so all across our business, we're really built to drive alpha in a systematic manner. And if you think about the alpha, one definition of alpha or pure alpha is getting paid for labor. And that's how I viewed life. I'd rather get paid for labor and doing the hard work and having a specialized engine than I would saying, well, I'm going to pay a really high price for this company and I hope it's going to keep going up, or whatever the risks that you're taking, hoping that you can do things. And that's just, again, it's a different way of operating. I get much more comfortable with lower valuations, lower leverage entry points, because what we've found, and I think data would support, is it's harder to lose money. And that's always one of our pillars at Star Mountain is let's start off with not losing money. A lot easier to make money if you don't lose it. But then you've got the valuation arbitrage and whatnot. And if you think about cash flow streams, it creates an asymmetric return of cash flows, right? Because harder to lose money, but it's, you don't have to change the world to take a company from, like recently one of our companies grew from 10 million to 150 million of EBITDA. Now that's an asymmetric outlier at the high end, but it's not like we found Google or something like that. Yet, the amount of returns we can make off that and tax advantage returns is quite compelling. So we like that.
So I don't want to compel you to give tax advice, but the QBS thing, QSBS, uh, my understanding is it needs to be a C corp at the onset of the entity. Is merging a new company provide an opportunity to cause it to be a C corp for the new aggregated company?
It does, yeah. Yeah, this is in the category of luck. I guess the being one quarter Irish maybe pays off every once in a while, and this certainly is one of those where many of our companies qualify in their size base. They didn't really under the previous code, but the updated one in July, they do, which is very exciting for us and our investors. And yes, we can sit down and structure the company as a C corp when we make that investment, and then you can help acquire other competitors, further professionalize them. And and the government's trying to motivate people to ultimately make smaller investments where it's hard to get rich on management fees, right? You create wealth from returns and performance. And that's really what we're built at Star Mountain. We invest a lot of our own personal capital. We share a carried interest with 100% of our employees. So we're all here to generate, asset returns, whereas, we're not doing multi-billion dollar deals where you can make the kind of money on fees. So that program works out great for both our what we call value-added lending, where we'll do a loan with a piece of equity, and within our private equity business. And then we're actually looking into that now within our secondaries business, which has some further tax advantages to it, including where we can buy a discounted portfolio of loans or an LP interest from somebody in a private credit fund at a discount to par. That pull to par can create a long-term capital gain benefit, again, for taxable investors, obviously not giving tax advice and so forth, as you alluded. But these are all things that can create, meaningful value. And there's perhaps some QSBS underlying value within that we're further exploring as well.
Gotcha. Isn't it also interesting or true that the people at the institutions at the higher part of the market are oftentimes having non-tax investors, so they're not paying tax, whether it be a
public pension fund or something,
pension fund, something like that. So
that's generally right. Yeah, I think most larger funds are typically going to have a lot of institutional investors, and at Star Mountain, we're roughly, half institutional investors and half, taxable family office and individuals and so forth that way. And at the end of the day, your non-taxable investors just care about the overall returns. And one of the other things that they like about Star Mountain and the lower middle market, in addition to the alignment aspect of our team, which is very important to them because they don't want to lose money. They know downturns can come and inevitably do. They want people that are going to really work hard through potential challenges, but they also want less correlated investments. And if you think about one of the benefits of the lower middle market is you can access companies like a special needs school bus transportation company or a pet hotel boarding and grooming business, a business that can be very, might be slow growth, basic, boring, but in the event of a market downturn, slow growth, basic, boring is good, right? Yeah. So something that can have a good total absolute return, but be very uncorrelated to geopolitical risks, large market technology and so forth, AI and whatnot, which may continue to transform, but certainly I think has created tail risks that we see a lot of investors now saying, I want to find some things that are good investments and less correlated. And obviously you've seen a run up in commodities and other things like that, but some people are saying, well, what does gold do for me? How does it create cash flow? Well, it doesn't. So in this case, you're finding things that are less correlated, but that have a fundamental purpose and a value to them. And that's where a lot of the institutions and some of like the large family offices that are really focused on generational wealth protection are getting very acutely focused right now.
Yep, totally makes sense. When there was a lot of talk about, the trades businesses, the HVAC and so on and so forth, did you find that activity in that area was interesting to Star Mountain?
It is, and we've made a lot of money during it, in fact, including with HVAC businesses and others. And if you think about the U.S. economy, it's largely a service-based economy that's hyper-fragmented. You overlay that with the aging demographics and that valuation arbitrage, and you kind of have a perfect storm. And so that dynamic persists. Now, what I don't think you want to do is chase hype, right? Because there are some things like, for example, one of my partners made a lot of money doing a consolidation of car washes. They built it up, sold it to Goldman Sachs. Everybody had a very successful exit. Then we recently looked at this other car wash business where people just felt like, oh, on paper, yeah, you just put up a whole bunch of car washes and they'll all be this profitable. Then you sell the higher market, everyone makes a lot of money. Well, yeah, but what if you have 3 car washes on the same block and people only need one? Yeah. Now all of a sudden you're fighting for labor, you have to drop your prices, and now all of a sudden you have a car wash you have to pay rent on and might be unprofitable, and all of a sudden an asset turns into a liability,
Right.
and that gets ugly really fast. And so I think people that chase hype, sometimes they get lucky, but rarely are they systematically successful. And that's where it's just like Star Mountain. Like, we don't invest in real estate. We don't invest in the energy sector. We're not investing in public markets. We know what we're good at. We're specialists at it. And I think whenever you see people kind of dabble in things or chase things that sounded interesting, just because it can be a good investment doesn't mean it will be.
That's right. And in your example, the car wash, 7 years ago, you could basically buy a car wash and have zero economic investment because of the tax benefits associated. That went away, of course. Still interesting business, but not like it once was. And maybe your friend participated in all that. There's a lot of tax benefits, as I recall. So let's.
Yeah, and I think you also don't want to, and that's where you look at your investor base, what you're doing. I don't think you want to I think you want to look at tax opportunities as an extra bonus,
Yeah,
but you want to be a fundamentally good investment that then has an extra potential, the icing on the cake, if you will, but make sure the cake is solid. I think people that chase the tax things, that sometimes there's like a window of time where that works, but then inevitably you end up having people that um, typically face losses and things. And we've seen it in
yeah.
solar and different things as well recently, that
Solar,
again, there was a period of time where
electric
people
cars.
made money, and a lot of
Yeah,
people lost a lot of money there.
yeah. That I think that's right. So, can you talk a little bit about your historical performance?
I can, to the extent of what I can specifically share. If people have questions they want to understand more about as business owners or as prospective investors, our team would be delighted to talk to them about, for qualified investors, what type of strategies and structures we offer to help them achieve their total return, income, diversifying, tax advantage, and other potential benefits they may have. But generally speaking, we've performed very well. I guess that's enabled us to grow both in protecting capital, generating solid current income on our income vehicles, and really staying true into our market opportunity that, as we talk about the aging demographics and whatnot, has continued to become a more compelling market. What we haven't done, and when I used to do asset management M&A 25 years ago, you'd see people build a good track record and then kind of jump up market with a bigger fund. And then all of a sudden they're in a different market and it's much more competitive. And then their returns, of course, diminish. So I think staying true to your market's critical. And that's where I think, in our case, we've had to be focused on investing a lot of our own personal capital, because you can't grow your management fee base the same level. So the way you create wealth is really making returns with your own money. I also think that the discipline that creates with your team is very different when people aren't trying to chase fees, but they're really focused on investing their
That's
own
right.
capital. I mean, it's hypothetically what we're all supposed to be doing, but if you look at people's incentives, often the incentives are not as aligned as one would probably hope.
Yeah, incentives matter. There's no
Yeah.
question about that. As long as somebody understands them, they matter.
Yeah.
Sometimes people don't understand them. Yeah,
Yeah. Well said.
yeah. So, what's on the horizon for you guys? Anything new you care to share?
Yeah, we're really excited about our secondaries business. I think a few things. One is different products we have. There's been a lot of noise in the market now about some of the larger market lending, and while a lot of people still want different forms of credit, which makes sense, I think a lot of people now are saying, well, I still want some credit, but where can I find some diversifying credit to what I'm already invested in? So I think we're seeing a lot of interest there, especially as rates are coming down. The ability to generate a potential premium yield is of interest. I think the second thing is within secondaries, as the market is bigger and more fragmented, you just have more people that may want early liquidity in lots of different types of funds. So again, we always like things where you have positive information advantage, motivated sellers, and a big market opportunity. And then what's also interesting about secondaries is if we do have a market downturn, it tends to have a bit of a counter-cyclical aspect where people are more panic selling and you can buy then assets cheaper. So it's not a hedge, but it kind of acts in a similar capacity. So I like that in my portfolio. I also like the taxable advantage aspect that you can get from purchasing ordinary income assets at a discount. And then within our private equity business, the tax advantaged aspect around the QSBS we talked about, I find those really compelling in addition to just the aging demographics aspect. So I guess we love all our children, and at different times they each act better than the others, but they all tend to perform pretty well across cycles.
Yeah, there's been a lot of talk and some wringing of the hands of many people that are looking for liquidity that just can't get it, whether it be an LP
Yeah.
interest in a fund or as an early shareholder in a company that hasn't gone public yet, right? Or
Yeah.
is about to. Are you seeing that
Yeah,
opportunity?
and if people are looking for early liquidity, please feel free to reach out to us. We what we don't do again is the venture capital stuff. So the shares in a company that didn't go public, that's a different world, a different way of you're kind of analyzing what you hope is going to happen in the future. We're better at analyzing fundamental cash flows, fundamental businesses, and more of that value-based investing. But if people are invested in private credit funds, private equity funds, private credit assets, private equity assets of companies and funds that invest in companies that do 5 to 50 million of EBITDA, again, if we can be helpful, we'd be delighted to see if we can be helpful in any capacity on that front. But I think that there will be more and more people that are invested in lots of things that are much less liquid than they hope they are. And I think that unfortunately for some creates challenges, and usually the flip side of a challenge is an opportunity. And so we're pretty geared up, and some of my partners that were executives at Fortress in the great financial crisis, had made a lot of money in the downturn, and we're pretty geared up to be defensive in what we're investing in, but also to look to capitalize on opportunities that we think are to some capacity inevitable over the quarters to come.
So just to be clear, you're interested in LP interests in funds in the segment that you can analyze, as opposed to the more venture shares that don't have a
That's
price
right.
on that. Yeah. Okay. Yeah.
Yeah, and if people want, we can help try to connect. If they're friends of yours in your community, Arthur, we'll always try to be helpful to some other folks that are in the venture space around there. But we won't be a buyer of that, but we can help people connect into that world. The venture world is a different world. I think you need to live and breathe that, and the risk reward profile is a bit different. We at Star Mountain really focus on trying to have the highest probability band of returns possible. We're okay not getting a 50% return on our money. We don't want to lose money. We want to try to make that, mid to high teens, and things go well again to the 20s. And if you can kind of systematically target those type of returns across cycles, that's really been what's worked well for us.
Does we could do a whole segment on the QSBS stuff, but does some of that pass through, not just in the value of the company that is now sold for the entrepreneur, in the tax advantages of that, but does that pass through to your LPs as well in some way?
It does. It's a huge benefit. That's why I'm personally putting a lot of more of my capital into that at the moment. In fact, we just had one deal where the greater than 15 million of profits for your pro rata piece, or 10 times your money. You have to think about that for a second. But if you can actually get over 10 times your money, potentially, depending on a lot of circumstances, tax free. Now, not often are you generating more than a 10 times return on your capital, but fantastic if and when it happens. But yeah, it's a very, for a U.S. taxable investor, this current window right now is incredibly compelling, in my opinion. I'm heading pretty deep into it because there's no guarantee the next administration will continue it. You just never know. But it's the aging demographics is there today, the valuation arbitrage is there today, and the tax advantage opportunity. And so that kind of trifecta is pretty compelling, and maybe for some of us a bit of a once in a lifetime even.
Yeah, it might be. In fact, we didn't know what was going to happen to it, right? When it came through the
Yeah.
regulations, and fortunately
Yeah.
it came through well. So let's
Yeah.
do this. If it's okay with you, let's do another one whenever we have time to do it with you and talk about that or some other subject more specifically and get into the weeds a little bit. Would
Yeah,
that
we'd
be
be
okay?
happy to. Yeah, and
Yeah,
we host some in-person things. We'd be delighted to kind of think about with your team as well. Like, it's great how you guys get together and share content, information all together, and always a pleasure, Arthur.
my pleasure. Yeah, it was great. Brett, thanks for doing this. And thanks everybody for listening in. Please feel free to share it. I feel like a YouTube promoter and trying to say, you know, click here. But yeah, thanks for doing
Somebody
this.
told me something about TikTok. I've never been on TikTok, but he said
Nor have I. Yeah.
it was interesting. I guess I mean, become pretty substantial.
The most interesting thing that I've heard that just recently on social media is that AI agents now have their own social media program and they're talking to each other, which doesn't sound good, but progress maybe. We'll
Yeah,
see.
that's funny.
Yeah.
Thanks, Arthur. A pleasure.
My pleasure. Thanks, Brett. Thanks, everybody.